G20 really is what everybody's talking about today.
Good afternoon, Stephen. Yep, that's it, G20. And how are the countries of the world going to address the imbalances at the moment on the trade front and currency front? So, yeah, pretty quiet market at the moment. And what have we seen so far today? We've heard the American President Obama just saying that his view is that his actions with regards to quantitative easing and their economic policy is purely to get the American economy back on its feet. And so there's going to be focus on what China, what the rest of the world have to say about the monetary policy in America, and it'll be interesting to see just what comes out of that. So for the time being, the currency is really not doing a lot at the moment. Euro a little bit weaker right now, but yeah, not a lot of action until we see something out of the G20.
And of course, we did have Timothy Geithner, the U.S. Treasury Secretary, recently calling for trade balances to be targeted at 4%. And of course, yesterday we had the US trade deficit coming out a little bit better than expected, but still $40 billion, whereas the Chinese trade surplus $27 billion. So it really goes to illustrate just how imbalanced the global economy is at this stage.
That's right. So it's all down to between America and China at the moment, and we're all aware of those imbalances, as you say. So yeah, I mean, Mr. Gunnion also talking on your program this morning and just saying how the weakness in the dollar at the moment isn't necessarily as a result of their quantitative easing, but more a show of more confidence in the global recovery and less of safe haven buying into the dollar and more moving away from that. So, it all needs to be wrapped up, and we'll get it over the next day or so.
Well, you said weakness in the dollar. We also have weakness in the euro, strong gold price. Is that where investors are heading at this point?
It looks like it. If you look at all the commodities, but specifically gold, and you could argue it's a good index of international investor risk aversion, and yeah, certainly that's where it's going at the moment. And you could argue that they're being paid to do so, I guess, with the dollar sort of weakening as it is. The gold price strengthening, it doesn't pay a return, but it's doing that just in its price action. So.
Well, James, let's take a look at that weak euro, because we have it trading just above 137 at this stage. Last Thursday, it strengthened to 143 against the dollar, or almost 143, after that quantitative easing package was announced by the US Fed. Is it really just the sovereign debt problems in Europe weighing on this currency at this point?
It does seem to be. I mean, also the strength in the euro was more as a result of a weak dollar with all the quantitative easing action that we saw last week. So probably a little bit of a retracement as the quantitative easing was digested. But once again, into the headlines comes those levels of debt that we spoke about and the positions those European balance sheets are going to be in at the moment. Major concerns. We're seeing all those yield levels over their German counterparts at all-time highs, close to default levels. So yeah, Europe is coming back into the spotlight at the moment, and I think it's a bit of both.
Well, China also in the spotlight this morning. It's had inflation data coming out for October, 4.4% rise in the CPI, PPI up at 5%, and both those numbers, I think, a little bit higher than the market had expected.
Correct. I guess there's a couple of things to look at there. I mean, China keeping their currency weak to make themselves a more competitive exporter has its consequences, and that's evident in the inflation. They were very aware of that in hiking interest rates to cool off any asset bubbles that they're seeing. So obviously weaker currency, better exports, but your imports are going to become more expensive, have been so, and that's it. It's been reflected in those producer prices, so, and feeding through to the consumer prices. So yeah, what are they doing? They've hiked up their capital requirements for banks to try and cool off the lending activity, and they've been hiking interest rates and are expected to hike again from its all-time low around 125. 125, probably another hike coming in at the next meeting. So yeah, and retail sales also a little bit lower than expected, but still coming in strong. So they're going to try and cool that off as well. So it's the right steps that they're taking at the moment in China, certainly.
Well, we're getting manufacturing data out, I think, 1 o'clock at South African time, which should, of course, give some indication of whether we're starting to see any growth coming through in the manufacturing sector. Mining numbers out in the meantime. Let's start with those. We had gold production down 4.7% for September. Total mining production, though, up by 12.1%. So that didn't look too bad, James.
it doesn't. There's a slight concern maybe with the gold price where it is that gold production's down. I think that's the only real number that sticks out in that. The rest of the commodities, it's a bit of a mixed bunch, but as you say, generally up, so that's good. But the gold being down with a higher gold price, you know, we'll have to look into that and see what the reasons and what's been happening there. Certainly, yeah. Manufacturing a bit later, as you say. It's not a great month to look at because you've had your manufacturing sector. There were some strikes there on the manufacturing parts area of that industry, so that's going to weigh on it, as well as the stronger rand affecting exports. So, and inventory accumulation also hasn't really picked up at all since the beginning of the year, where we saw better manufacturing numbers. So ultimately, it's going to be a low number. I think if it comes within expectations, it'll be, you know, discarded. But any shock to the downside will certainly add some sort of momentum going into next week's MPC.
Well, what's the market looking like at the moment? The bond markets, are we still pricing in that cut next week?
Yeah, 60% of a chance, really, if you look at the short-end FRAs, FRAs. As far as the bond market, it hit its lows on the R157 of just around the sort of 680, 687 level, and it's moved back and trading around 7%. I think, you know, if anything, it's reacting to two things. Certainly, any move in the US Treasury seems to be affecting our local stuff with the lack of any other sort of influences. But also going into the MPC, there will be concerns that if the market's discounting 60% chance of a cut and you're holding bonds, you're probably going to look to lighten up some of that position, just in the outside chance that the MPC decides and motivates no cut next week.
And if there's no cut next week, do you think that we're likely to get that cut coming through in February?
That's the official view of Nedbank, certainly, is that we expect a 50 basis point cut between the November meeting and the first quarter of next year. But most likely, you know, in my opinion, if sooner would be better than later, I would say, given, you know, what we're seeing internationally. But yeah, if we don't see it in November, certainly the market will still price in, unless there's some communication to the contrary, it'll price in a chance of a cut early on next year. More likely outcome would probably be a cut at this meeting, we'd think, and you know, leaving the door still open for further cuts next year. So yeah, that remains to be seen.